Welcome to chapter 9. So what we're going to do in this chapter is going to talk about how do you value stock, what is the intrinsic value in the stock price. So outside investors, they want to analyze it and determine what the stock value is before you buy and sell the stocks. Are they undervalued or overvalued? So there are different models that they have that they have come up with. So the constant growth stock, a constant growth stock is a stock that is expected to grow at a constant rate for the foreseeable future. So it fits some firms which tend to grow over the long run with the same rate as the economy. And there are more complicated models which we will not go into. It can really go into depth. So the constant growth stock is simply the Gordon growth model which they have is the dividends because the present value of all the expected future stream of dividends is how you can determine the value of a stock. So you take the dividend divided by 1 plus so 1 plus the growth model divided by the expected rate of growth. Okay, let me go back to it. So if G is constant, the dividend growth formula converges to D1 over required rate minus the growth rate. So but if G is greater than the constant growth rate, that leads to a negative stock price, which does not make sense. So you can only use it when the required rate is greater than the growth. So G is expected to be constant forever. So value of a stock is nothing but the present value of all future dividends expected to be generated by the stock. So dividend divided by 1 plus the required rate of return. So it's the present divided by the present value. You're finding the present value of the stream of dividends. So that's how you determine the value of a stock. So if the current dividend is $2, dividend are expected to grow at 5%, then the required rate of return is you're discounting the dividend by the 10% rate of return and finding the value of it. So the growth model, what it says is you take the dividends and divide it by R minus G. So $2, which grows at the 5% rate, divided by the 10% that it's the required rate minus the growth rate. So you basically $2.10 divided by 5% is the $42. This means the stock should be $42 to give you a rate of 10%. So that's how you can measure whether they're overvalued or undervalued. So preferred stock is another stock that is has a par value and it has a preferred dividend rate, and they're generally fixed. Preferred stock can be valued at a constant growth stock with a dividend growth rate equal to 0. So it becomes a perpetuity essentially. So find the share of a preferred stock given the par value is 100 and the dividend is 10% and the required rate is 12%. So you take the dividend and divide it by the required rate of return. It's the same as the constant, but the G is 0. So because that's the constant return on the stock, so that's a zero growth model. So 10 divided by the 12% is $83.33. So if D equals 2 and G is constant, find the expected dividend stream for the next 3 years and their present value. So that's what you're doing essentially, is discounting it to the present value. So your $2.12 for year 1 is the dividend has grown by the percentage, so it's 212 divided by the return. You require the return of 13%, but it's already growing at 6%, so you don't need that. So you divide it by the 7% to determine the stock price. So that's how you calculate that. So D1 will have to be paid out already. So P1 is the present value from year 1. So D2, again, you can do that for the next year, and you can figure out the value of the stock. So dividend yield is nothing but the dividend that you have received divided by the price to get what kind of a return are you getting on your on the stock that you have paid. Capital gains yield is what the price that you sold at minus the price you bought at, and divided by the price to find what kind of gain did you get on the capital part of it. You got 6% on that. So your total yield is 7 plus the 6%. You got a return of 13%. So what would be the expected price of G equals 0? So again, it's the it would be a perpetuity. So the dividend stream, that's your preferred stock. So what if G is 30% for 3 years and then you have a supernormal growth of 6%? So then the growth becomes constant. So you're growing the value, you're going to discount it at that rate, and then later on you're going to discount it at the different rate, and that becomes more complicated. So we will not be doing those type of problems. So if the stock is expected to have a negative growth Would anyone buy a stock, and what is its value? The firm still has earnings, pays dividends, even though it may be declining, they still have value. So here you have 13% and the stock is at negative, so you need a 19% return. So your stock still has some value, and you can still value the stock. So mostly the average annual returns on large cap stocks is 12.83, and US T bonds is 5.41, T bills is 4.10, and inflation is 3.20%. So the risk premium is the difference between a risky investment's return and a riskless asset. So based on historical data, again the risk standard deviation is 20.8 for large cap stocks. US T bills is 3.25. So that's the capital market history. So in equilibrium, stock prices are stable and there is no tendency for people to buy or sell. So two conditions have to hold true. The current stock price equals its intrinsic value. Otherwise, trading is not going to happen at that point. Expected returns must equal required returns. But usually, investors have different required rates of returns. So the stock is not always valued at its intrinsic value. Either it's overpriced or underpriced. And that concludes this chapter.